Hey, everybody, it's Michael Martin. Thanks for joining us today. Again, I've got Jared Dillian, Sean McLaughlin, and Brian Shannon from Alpha Trends here for the show. We're going to go over a couple of ideas. Guys, I mean, what a world we live in. These are the strangest times that I've seen. We have to cull the hog herd because the meatpacking plants and slaughterhouses are closed for COVID-19, despite the fact that we've got increasing demand from China. And you see May, June, July, and August on the strip go limit up. I haven't seen that too frequently in 30 years of commodity trading. I've seen crude up 3.5% today, which I'm going to share with everybody, right here. And I'm looking at this saying, okay, we got 50 million barrels of crude hitting the shores of the United States, and the market's up 3%. We're still below the 20-period EMA. That's what this is here. It's kind of what commodity guys use as a trend line. So I'm not getting my hopes up on the crude at all. I'm just saying what they're doing right now is probably trading sideways to meet up with the trend line just in time for a good low risk short entry on that chart. And then very quickly, another one that I look at just because we're kind of in the neighborhood here is Walt Disney. And, with Disney, it's tricky because the theme parks are, I don't know, if you can see Disney, can you get, yeah. The theme parks are still a big chunk of their revenue stream, and we've got the stock up over its 20-day exponential moving average, yet we have below average volume right here, which is kind of what I use as an indicator to make sure that I'm kind of playing with other people. So I'm not saying that this is a false breakout, but I'm very suspicious on moves like this. If you follow Victor Sperandio, he also created a 1-2-3 reversal, which you kind of see here too, but I don't really trust this move. And we're coming into earnings. Crude's down. ExxonMobil's going to report before the open on Friday. Things paying almost 9% dividend yield. I think this is still a time, if anything, that you want to be super careful in this marketplace and be careful and always protect your capital. Brian Shannon, I'm going to start with you. What's your take on all of that?
I agree with you. As far as the volume of Disney goes, only price pays. If you look at the volume in the SPY, every single time we have one of these rallies, the volume starts dropping off and everyone starts bitching about it's up on light volume. And that's all they talk about is the volume, but the price is going up. We don't get paid in volume. We get paid in dollars. We get paid in price action. I'm going to say it over and over again on this show. Only price pays. I don't care about that other nonsense.
All right. Well, let's take a look at your chart here that you put up. Is very handsomely appointed. I appreciate you doing this too. What are we looking at here?
That's the S&P 500 chart, the SPY. I should have put volume on there. Actually, now, Michael, and I didn't realize we'd be talking about it. But you would see that prices are ramping up and volume is just dropping off a cliff. And everyone says, don't trust it because it's low volume, whatever. But we're up 35% off the lows, and we're only down 9% year to date in the SPY. The NASDAQ is up 3%. What we're looking at here is, every single level of resistance, we've blown through it. People will say, oh, we have resistance at the 38% retracement. We have resistance at this moving average, or we have resistance at that volume weighted average price. I always say we have potential resistance at a level of interest. When it gets up to that level of interest, whether it's on light volume or heavy volume, whatever you want to characterize it, we look at it and say, okay, now we're in an area where we might find enough supply to offset the demand. So let's tighten up our risk. Let's look at shorter term timeframes and look for evidence that maybe the market is rolling over, and we're just not seeing any of that evidence. So now we're right at the 61.8% retracement of the year range from that high that we saw to the recent sell-off low. And, we're maybe going to head through that up to the 200-day moving average at 300. So, we've still got still got upside momentum. It's just not time to be looking short.
Hey, Brian, let me jump in on the volume piece that you said there. I totally agree with you. Every time we see the market rally and the volume comes down, you get some smart aleck, pointing out that the volume is dropping. But of course it's dropping. And that sell-off, we were seeing record volume. I mean, that's such a high bar. The market could do anything and the volume is going to be lower than what it was doing in the end of March.
You know what, Sean, too, and that's why I use the volume weighted average price. I want to know from that low. If I anchor from that low or at a higher low somewhere in there, I'm going to see that the volume is following price. So we're seeing higher price action. That's what matters. It's not how it is relative to the volume 6 months ago. That's completely irrelevant for trading or for most types of, even investing. I think that you have to look at it and I said the other day on Twitter, thank God we're not hearing all this chatter about the volume. I think people are finally getting a little bit more educated that you don't need heavier volume to move higher. It's a lack of supply. We had people puking in their positions and margin calls getting forced out. Now we've got a lack of supply and this FOMO based on, is it just because of the Fed or who cares? The fact is the market's moving higher.
Jared, what say you about all of this? Do you care about volume?
No, I agree with both of these guys. I did want to point something out pertaining to what you said in the beginning about oil. If you haven't looked at a chart of XLE in a while, XLE is almost back to where it was before the Saudis started pumping, which is absolutely incredible. No, I have a trade based on the S&P here. If you want to bring that up,
Will do.
We can talk about that. A lot of people have been fighting this tape. I've written a couple of pieces. I wrote a piece in Bloomberg the other day about how people are letting their personal feelings about the market get in the way of their trading. We've had just extraordinary levels of intervention from the Fed and the federal government. What I will say is, if you are still bearish, there's cheap and easy ways to express this. And the other day I was looking at the 2200, 2500 put spread in the S&P. Now, a couple days ago, this was trading at about 70 points. Now it's probably about 60, which means it has about a 5-to-1 payoff. And the 2200 leg on the puts gets you to about the low during the crash. So I think, if you are bearish, instead of just being naked short, I think this is a pretty cheap way to express that.
So would someone use this as a hedge maybe, as opposed to buying gold if they think gold is toppy? Or would you look at this as maybe a trade along the lines of like a Nassim Taleb kind of, improbable but black swan kind of move to the downside?
Yeah, I mean, this is, I don't know what scenario this happens. Maybe we get a second wave of infections or something like that. But it's definitely a hedge for sure. This is definitely a hedge.
Gotcha. So since I'm the odd guy out, the only thing I will say is that I too trust price. I've made, my business based on following price-based models. I just tend to trust the price a little bit more when I can see that there's other people at the party, not just me. But I'm willing to learn too. I don't have all the answers. Just how I was basically self-taught. So I kind of put these things together myself. And, this is what makes for a good horse race. I like the put spread idea. Certainly we can see that this market fell out of bed so quickly and seemed to have recovered. So I certainly know we could see 2,500. It's totally possible. We're coming into earnings, and I know only the price pays for sure. But I think it was Jared or Brian had said last week when we were kind of chatting that when you look at the market itself, this is not necessarily a broad-based rally. Is that still the case when you look at the move on the indices going higher? Brian?
Well, small caps have had a couple of big days, and especially micro caps. You've seen some explosive moves higher in micro caps. So you're starting to see more participation.
Yeah, I'd agree with that. I mean, the Russell 2000 is still the laggard of the groups that, the major indices that I follow. We're still down 18% year to date, but this week we're starting to see some catch up. We're up 10.5% in the Russell 2000, in fact, and that's triple what the S&P has done and about 5 times what the NASDAQ has done this week. So we're definitely, seeing some catch up in that market, and that's, broadening out and lending more support to the bullish thesis.
From a market psychology standpoint, do you have a sense though that people might be getting a false sense of security? I mean, crude having trade negative and still not really being that high. There's, certain price points that companies need in the refining business in order to be profitable. There's a gigantic glut. Oklahoma Cushing is at capacity, and we don't know how long that glut of oil is going to last, how long it's going to take to work through the system. You had Google report numbers that were, I guess, on the disappointing side, but the stock was still up. Facebook is kind of in the same boat coming up. And do you think earnings could be the other shoe that drops on the market?
For me personally, it's on a stock by stock basis. I don't look at the broad picture in that regard. But you could also look at, the worst GDP this morning, and yet we were still up, a couple percent here, overall in the market. So it's tough to look at the headline and try to make sense of what the market's actually doing.
I got you. Sean, you all had a good report coming up. I want to call up your screen here. That was very, very interesting. Walk everybody through this.
Sure. So this is a chart that we shared with All-Star Chart people recently, and it shows the performance of gold relative to the S&P. I'm really just paying attention to the top part of this chart here.
Yeah.
And as you can see, going back for a little while here, but better part of or more than a year, the trend, while it's been a roller coaster ride, the overall trend of gold versus the S&P has been up, and it shot up as this crisis unfolded this spring. The million-dollar question that we're all asking right now is the move over, and are we going to start heading back down and stocks become leaders again? I'm not sold on that idea. Much like Brian, I believe that the only price pays and the trend is your friend. And the bet we're making is that gold is probably is pointing to resuming its outperformance against stocks. And we took a position today that reflects that.
How'd you, you did it in GLD?
Yeah, so we did it in GLD. I don't have a chart for you. I don't know if you have a GLD chart handy.
I get it.
But we sold June puts in GLD. Right. Now, as a premium seller, I prefer to sell into high volatility tape, and certainly volatility in gold has come back a lot from where we were at the end of March. And that's true pretty much across the board, across all equities instruments. But that said, premiums still remain elevated, compared to this time last year and even like at the end of 2019. So there's still a lot of juice left in options. And with gold trading, we put the trade on this morning when gold was trading around 160.5 GLD. Sorry, was trading around 160.5. Right. And I was able to sell the 150 strike in June for $1.30. Which is, I felt like it's a pretty good premium for the risk I'm taking. And I got a lot of room to be wrong. Those options don't go in the money for, another $10 lower from where we're at right now. There you go. There's a chart.
This is the GLD here.
Yeah. So as you can see, I was able to sell the 150 strike, which just looking at that chart, you can see we got a lot of room to be wrong. And it's not an aggressively bullish trade. My thinking here is, gold, the trend is higher, but hey, we might set up in some sideways action here for a little while. I mean, the S&P's had a huge move. Gold has had big moves. I mean, everything is at some point, I would think, due for some kind of pause or some kind of rest. So selling the 150 puts in June, just to me feels like a good trade. We got a lot of room to be wrong. Like I said, obviously, if we get down to 150, that's my out. I'll be looking to close out of the trade at that point. I'm not interested in holding naked puts that are in the money. But hey, we've got time until June, less than 2 months until expiration, and this is how we're expressing this trade. We think the gold outperformance either picks up and resumes, or at least holds steady. Either case, we win.
Either way, you win. So just to reiterate, you sold the June 150 strike puts on the GLD.
That's correct. Yeah.
And keep in mind, folks, with everybody here, this is meant to be somewhat entertaining, somewhat educational. You have to figure out, in speaking with your financial advisors, if doing any type of trading or investing is appropriate for you, given for where you are in your life, what your taxes are, what your income is, what your years to retirement is, and what your number of dependents are. So take it with a grain of salt. We're talking about the things that we are looking at. If you affect these transactions, you do it on your own volition here. Brian, where's I know you've written the book on trading in multiple time frames. Where can people learn more about the VWAP and its significance?
The volume weighted average price, it's VWAP. There's an
VWAP.
A in it, not an O. All these East Coast people pronounce it with an O.
Don't get Brian started. Don't get him started.
I've got a bunch of stuff on my on alphatrends.net. There's a tab that says VWAP, and you can scroll down from there. I've got a bunch of educational articles and videos that I've done there about it.
Very well. Well, that's all the time we have for today. I want to thank you guys for taking the time. Thanks everybody for listening. I will have show notes on this too, and I'll send them out to everybody and publish them so people can see. Appreciate your time. We'll see you again next week. Thank you for watching the show today. My guests were Jared Dillian. He's the author of a great book called Street Freak. He contributes to Malden Economics and Bloomberg. You can find him at dailydirtnap.com, where he has a newsletter of the same, and on Twitter at dailydirtnap as well. We have Chicago Sean McLaughlin, good friend of mine as well. He is the chief option strategist at All Star Charts and the senior market strategist at Trade Ideas. You can find him on Twitter at Chicago Sean. Brian Shannon, CMT, author of Technical Analysis Using Multiple Time Frames. He can be found at alphatrends.net on the internet and on Twitter at alphatrends. I'm Michael Martin. I'm the author of The Inner Voice of Trading. You can find me at martinchronicle.com and at Twitter at the same. Trading is risky and you can lose money. Anything that we spoke about today is for educational purposes only and not to be construed as a trade recommendation in any of the instruments or asset classes that we spoke about. Please consider speaking with your financial advisor to find out if trading is appropriate for you. Thank you for watching. We'll see you next episode.